There's some interesting growth and income opportunities in real estate, and here to tell us more is our growth and income stock strategist. I had to say that slow. Todd Bunton, because my tongue gets caught between my eye teeth.
It's a mouthful.
Can't see what I'm saying. AvalonBay Communities is one opportunity. This is a REIT.
Yeah, Real Estate Investment Trust. They're actually an apartment REIT, so they're focused on apartment communities. They have over 270 apartment communities in several states, in actually 12 states, mostly on the East Coast and the West Coast, which are very high rent, high barrier to entry markets. So their average rent is actually over $2,000 a month. So they're seen as one of the kind of a best-in-class operator, very high-end type apartment homes. And you've seen in the apartment industry, I think it still has very solid fundamentals going forward. Maybe not as strong as a year or 2 years ago, but you're still seeing increases in occupancy rates and solid increases in rental rates. And that was definitely seen by Avalon in the last quarter. They saw almost a 5% increase in average rents year over year and a 0.2% increase in occupancy rates. So very solid fundamentals here, and that's driving solid bottom line growth and actually led to a pretty solid earnings beat last quarter, and that prompted analysts to raise their estimates going forward, sent it to a Zacks rank of 2, which is a buy rating. So very good earnings momentum here. And if you look, analysts expect about 16% funds from operation growth this year, 8% growth next year. So still solid growth here in the apartment industry. And like I said, AvalonBay is seen as a kind of a best-in-class operator, so this is a high-quality name within that space. And along with that growth, you're getting a very solid dividend. They pay a dividend that yields 3.1%. Now, as a REIT, they have to pay out at least 90% of their earnings in the form of dividends to avoid paying tax on that money. So as their funds from operation grow, expect that dividend to continue growing. But if you take a look at their dividend chart since the year 2000, you can see they've steadily increased that, about a 5% compound annual rate since then. They held it steady through the Great Recession, so very shareholder-friendly company. And like I said, you can expect that dividend to continue growing over the next couple of years. And in terms of valuation, REITs in general have sold off over the last month and a half as interest rates have risen. But I think that sell-off might be a little bit overdone. And if you take a look at their valuation, you can see why. They trade about 21 times forward earnings. That might seem kind of high on an absolute basis, but if you look over the last 10 years, they've averaged about a 22 times forward multiple. So it is a slight discount to that. Seems to be a decent value, especially considering the strong growth potential here and the good income. Could be good total return potential this year.
All right, the other opportunity is a REIT of a little different type.
Yep.
Tanger Factory Outlet Centers.
That's right. They do outlet centers, as you can tell in their name.
I could tell by the name, yeah.
Yeah, so more retail focused. But there is strong demand for outlet centers, too, from retailers. And if you look, this company has over 98% occupancy in its malls. They actually have about 43 outlet centers in 26 states across the coast, some in Canada. But like I said, super high occupancy rates, solid demand, and that's leading to solid bottom line growth as well. Kind of similar story in the apartment space. The company has solid earnings momentum. They've delivered 2 consecutive positive earnings surprises. We've seen analysts raise their estimates pretty solidly over the last few months, sent it to a Zacks rank of 2, which is a buy rating. And good growth ahead for this company, too. Based on consensus estimates, analysts expect 11% funds from operation growth this year, 10% growth next year, so low double-digit growth. And with that, you're getting a dividend that yields 2.7%. If you take a look at their dividend history, they've increased their dividend about a 3% compound annual rate since the year 2000. But they have increased their dividend every year for 20 consecutive years, so very shareholder-friendly here.
That's good news, yeah.
Yeah, that'll put them in the dividend aristocrat category pretty soon in the S&P. So very, very solid income, very solid growth, and all at a pretty reasonable price. They trade about 18 times forward earnings. That's in line with the industry median, so there could be solid total return potential in this name as well.
Dividend aristocrats. I've never heard of that.
Yeah, that's
Is that a newly opened up wing or something?
No, it's something that Standard & Poor's does. It's for companies. I forget the actual criteria, but it's companies that have increased their dividends every year for at least, I think, 20, maybe 25 years, and they're getting close.
Okay. Do you own either of these two?
I do not.
All right. Check out other stock picks and stock picking strategies, and they're on our website, zacks.com. If you're not there already, get on over and check them out. With Todd, I'm Terry Ruffalo.